Hello and welcome back. As Netflix is crashing today, we can actually take a look at what's going on with the Nasdaq. It's actually down almost 1%, approaching 1%, but Netflix down 36%, absolutely destroyed here today. A lot of Nasdaq companies, a lot of tech companies are actually following a similar play as a sympathy play, sort of, because when one of the big companies is actually down, a lot of the tech industry will follow. It tends to happen with companies that are related to the industry. Happens a lot, and you will see here that Facebook is actually down 7.28% today for no real reason. Again, just because it's following the trend. And I wanted to make a video. I have made quite a few videos about Facebook. It's actually my largest holding. I was actually lucky to buy at about 150, as I mentioned in the past. I bought at the previous crash, sort of the stock with the Cambridge Analytica scandal. Now we're having another very, very interesting one in which I feel it's a amazing opportunity, really. Right now, Facebook must be the tech company that is the most undervalued company based on what it is and based on the financials that the company is achieving. So I want to take a little bit of a look because it's important to understand and important to notice that when the stock market is crashing and things are going down, this is when we should be acting. And most people tend to be scared here, tend to be selling, and they don't really want to be buying. As I mentioned before, for some reason, the stock market is one of those things that people like to buy when it's expensive and not when it's cheap. The correct way to do it is actually buy when things are cheap, especially when they are good things, of course, because we don't want to just be buying anything. And you will see here that in the last 6 months, the stock price has been actually plummeting in terms of Facebook. It used to be, the 1 year high was 384 over here, so it's down almost 50% right now today. Absolutely insane for a company of that sort, based on what they are doing. And I want to examine the financials in it a little bit, and I have made videos about it in the past again, but I feel like at this current level, $200, this really deserves a video on its own, just because it's insane to me, like how cheap this company is. Now, as you see here, all these are green check marks, and let's examine them in detail here. The price to earnings ratio is actually going down and down and down, and it's actually 15.3. And even at these levels, I would potentially think about buying Facebook because it's a tech company that has high growth. And when there is high growth, I'm willing to pay more for a company. And right now, Facebook is actually at a 15 PE ratio, which is absolutely insane for a company of that sort, as I mentioned earlier. What about the price to free cash flow ratio? Is the same story, 15, less than 15 actually. And outstanding shares that keep going down because the company is actually buying back shares. And frankly, I would like them to buy back more because the stock price right now is insanely cheap based on what the company is doing. So I really, really want them to keep on buying. Right now, it's a massive opportunity. The free cash flow to total liabilities is sitting at 1, meaning that last year's free cash flow is enough for the company to pay all the total liabilities that they ever had and basically have zero debt and zero liabilities, which is tremendous. I mean, they basically, practically speaking, have no debt. It's super well managed. 5-year revenue growth, look at this growth over here, growing tremendously as well. And same thing with the 5-year net income growth, all things are looking amazing. And the total equity growth, again, pretty much growing for the most part every year. A price to sales ratio, which is a little bit more expensive than you would like it to be, but look at this. Price to sales ratio, by the way, is the price of the stock when divided by the revenue that the stock is doing, the company is doing. And so typically, as you'll see here, and I have the little help, we would like to get something that's between 1 or 2. This is a little bit more expensive here, but it's not our core metric here. It's just nice to have. I am much more interested in things like the price to free cash flow ratio, for example. Now, there are some other amazing things about Facebook as well. Look at these margins here, 34% almost, absolutely awesome. Debt to equity ratio, practically speaking, no debt. And look at the current ratio. This is current assets divided by current liabilities. It's 3.15, meaning that the company has 3 times as many current assets than current liabilities. And by current, we mean the ones that can be liquidated in the next 12 months, short-term assets. And the same thing for short-term liabilities here, meaning that the company pretty much has no risk in terms of short-term liabilities and debt. And another amazing thing here, the return on equity and the return on invested capital, 30%, 32%. I mean, these numbers are amazing. The company is making great returns on equity, great returns on capital. Amazing thing for an investor. These are some of the values that are super important for a company, and they're amazing. They're looking awesome. The price to book ratio is a little bit more expensive here than I would like it to be, but of course you don't judge a company like Facebook from its assets. Especially software companies, they don't tend to keep too many assets really, and so yeah, this practically speaking is almost non-relevant for a company like Facebook. Now, everything is looking amazing here pretty much, but what I always want to do, you know me, I want to find what's the price to pay, because that's what matters. And look at these revenue numbers here. The company has been doing amazing. Like I'm looking at these numbers and I'm salivating, like seriously. And I don't care about what the company is doing right now because these numbers are absolutely insane. And yeah, even if they go down a little bit, okay, I'm okay with that. And let's actually make an exercise on this one. Let's say that the revenue growth of Facebook is going to be pretty much horrible compared to what they were doing. Let's say they're going 10%. 12 and 14 for the next 5 years. This is probably not happening because the lowest they have gone is 2160 for just a year, and the highest was 47%. So I wouldn't be surprised if they keep doing this kind of 20% or so. Last year they did 37%, so why not? The net income margins here, 39, 39, 26, 33, 33. So we're gonna go 30, 33, 36. Makes a ton of sense, right? Free cash flow margin, again, we're gonna go something like 80, 90, and 100 is what about they are making. And yeah, this is numbers that I love to see because they are very consistent. You see here they are almost the same every year. There will be some exceptions, but overall they are very, very close to each other. Even the margins are very close to each other. And yeah, I just love when companies do that because they are steady. They're producing steady free cash flow, steady growth. Amazing, just amazing. And annual return is 13%, what I typically want to make. And I hit calculate here. So what are we getting with this kind of revenue? So look at this. Even with this kind of lackluster revenue projections here, we are looking at the max price to pay of 250 while we are at 200. And the medium ones are 335. What about the high ones? High ones are a 14% revenue growth number over here. So we're looking at 441. That's the number to pay today in order to achieve 13% gain every year for the next 5 years. So what if we try numbers that make a little bit more sense based on what Facebook has been doing so far, if they keep growing like this? So let's go 15, 17, and 19, just for the exercise, which frankly speaking, I think these are the numbers that I would potentially use for Facebook. I don't think they're going to be growing at 10% every year, Facebook. I think that it's going to be a little bit more. But let's try these and hit calculate. And now we're looking at 300, 400, 537. And this is why I love Facebook over here. Let's just try revenue growth of 5%, 5, 6, and 8 over here. Again, we hit calculate. This is why I love this tool. You can actually play with the numbers and see exactly what's going on. Even with a 5% revenue growth right now, we are here. This is pretty much the exact price that we are getting right now. And for this kind of revenue growth, 5%, which is almost nothing, we will be getting 13% of a return for the next 5 years based on the discounted cash flow model here. So yeah, this is why I absolutely love Facebook right now, and this is the core reason why it's my top holding. And frankly speaking, if it wasn't my top holding and I wasn't maxed out on it, I would potentially even think of adding more here. This is so tempting, I'm telling you. Yeah. So tell me what you think about Facebook. I mean, it looks like the market is actually giving amazing prices in terms of the stock. So tell me what you think, leave a comment below, and I'd love to hear from you. And please remember to like the video, that helps a lot, and subscribe if you're not a subscriber. Probably next week or so I'm opening up this tool to subscribers and viewers. You may want to be around for when that happens. I will let you know how to get to the tool, how to get access. So thank you for watching this one, and in the meantime take a look at this video that I made earlier. And in this one I'm discussing what's going on with Twitter and its recent sale. Its recent sale of shares to Elon Musk, I meant to say. So thank you for watching this one, and I'll see you soon. Bye bye.